Hello and welcome back to our channel Quant Alpha, where we decode the complex world of quantitative and algorithmic trading. Today's video is all about a powerful and often misunderstood high-frequency trading strategy, Spatial Arbitrage. We'll break it down step by step, covering what is Spatial Arbitrage, how it works in real-time trading environments, and how HFT traders and quants exploit this strategy to generate risk-free profits across exchanges. In a globally connected world, the same asset can trade on different exchanges, sometimes with slightly different price. These price difference across location form the foundation of spatial arbitrage. So let's dive into how spatial arbitrage works with real world examples, technical mechanics, and the edge high frequency trader use to execute this strategy with milliseconds. In spatial arbitrage, you are buying an asset in one location or market where it is cheaper, and at the same time you are selling it in another location or market where it's more expensive. So the difference is the profit. So let's understand this with an example. Let's say a trader is monitoring the stock Reliance Industries, or you can say Reliance, on both major Indian stock exchanges, which is NSE, which is National Stock Exchange, and BSE, Bombay Stock Exchange. Suppose at the same time in NSE the price is 2500 and the BSE the price is 2510. So there is a 10 rupees difference for the same stock. Now the arbitrage strategy is simple. You buy, let's say 100 share or 1000 shares of Reliance on NSE at 2500 and sell 100 share of Reliance on BSE at 2510. Let's say if you bought 100 share, so the profit is 100 into 10, which is 1000. Now imagine if you bought thousands of share, so your profit will be huge. That's a simple example of spatial arbitrage strategy. Let's take another crypto spatial arbitrage example. Let's say Bitcoin on Binance USDT is $30,000 and Bitcoin on Coinbase USDT is 30,050. So someone can buy one Bitcoin on Binance at 30,000 and sell one Bitcoin on Coinbase at 30,050. So the difference $50 is the profit. So now you understand the spatial arbitrage. The asset must be same whether it is stock or crypto, but the exchange are different, physical or online. So the price are different in different exchanges. Now let's talk about the challenges. First one is latency and speed. In spatial arbitrage, milliseconds or even microseconds matter. If you are not fast enough, the price difference may vanish before you trade execute. HFT firms invest heavily in co-location and low latency fiber to overcome this. Now the second one is exchange connectivity. Accessing multiple exchanges require API from each exchange's physical or virtual presence, which is co-location servers, and infrastructure to manage simultaneous order routing. So this setup is really expensive and technically complex. Now the third one is regulatory and market access barriers. Some exchanges have restriction for foreign participants and regulatory environments differ across countries. Take an example, taxes, capital control, reporting. So all these is actually matters. Now the fourth one is liquidity risk. If there is insufficient liquidity on one side of the trade, so you may only partially fill your order. So the worst is basically you can fail to hedge it. So this can expose you to significant directionally risk. Now the fifth one is slippage and execution risk. Price may move between the time you detect an arbitrage and the time you execute. So slippage reduces profitability or causes maybe a loss. Now the sixth one is transaction cost. So arbitrage profits are often razor thin. Commissions, exchange fee, and taxes can wipe out the profit if not properly accounted for. Seventh one is currency conversion risk. When arbitraging asset across countries, forex rates fluctuates can impact net gain. Now real-time FX hedging may be required to manage this. Now the eighth one is technology failure. Now glitches in pricing feeds, order execution, or internet connectivity can turn an arbitrage into a loss. And the last one is market fragmentation. The same asset might be listed differently in terms of lot size, symbol, or trading hours. Making synchronization is really hard. Now this requires smart logic to normalize and compare price accurately. So in summary, we can say the challenges are latency and speed constraints, exchange and regulatory access, liquidity and slippage risk, high infrastructure cost, and FX and transaction cost impact. So now I hope you clearly clearly understand what spatial arbitrage is, how traders, especially in high frequency trading, makes money from it, and the key challenges they face in real world execution. So if you are planning to build a spatial arbitrage strategy, make sure you are fully aware of all these aspects, from latency and connectivity to regulations and slippage. If you found this video helpful, please don't forget to like, share and subscribe to the channel. It will help us grow and bring more powerful quant and trading strategies to you every week. Thanks for watching. I will see you in the next one.